Good afternoon, everyone. Thank you for taking the time to view our presentation on Erie Proprietary Limited. So our company here is Chester Consulting Ltd, and today we have Randito, our R&D manager, Sean, our production manager, and myself, Kelly, the finance manager, here to present today. Unfortunately, our marketing manager, Delton, has not been able to attend. Alright, so in this presentation, we'll be discussing and reviewing Erie Proprietary Limited, which is a multi-million-dollar sensor manufacturing company, and we'll be looking at all their data from the company's lifespan, so that's from 2019 up to our current year of 2027. So I will start off by discussing the company's story, their strategy, and any mistakes that they've made. And then I'll pass on to Randito, who will discuss the competition analysis and any real-life comparisons. And then over to Sean, who will go through our future performance and the company evaluation. Alright, so Erie's story. I'll start off with their mission statement and their values. So when we asked them what their initial strategy statement was when they first formed the company, Erie stated that their mission was to deliver low-cost products to low-end and traditional markets while maintaining a reasonable profit margin. So while they've had some tough competition in the sensor market over the past 8 years, they have also incurred some critical events. So in 2019, they had a $1.95 million loss. Again, in 2023 with a $3.9 million loss. They also had a couple of emergency loans come out. So in 2019, they incurred an emergency loan of $7.79 million. And then again in 2023 of $11.1 million. Also in 2023, they had a change in their management with Randito leaving and getting Christy McMaster replacing him. And out of their initial 5 segments, they've also sold off their performance and size in 2021 and 2024 respectively. So over to the company's strategy. So to regularly check against any of their performance of the team's mission statement, they formed a strategy to focus on the market, production and finance intents that they incur. So their marketing was to invest in products in their low-end and traditional markets, which goes through from their strategy. They wanted to keep their research and development investments low and keep their prices below competitors. Their production, so they wanted to increase their automation in their low and traditional segments and sell off their markets in their performance and size. And while doing this, if they needed any financing, they were focusing on purchasing long-term loans where they were required and prioritising issuing of stocks when they had profits. So moving on to any mistakes that they've made over the past 8 years, starting with their research and development, if we have a look at these graphs here, they never really reached the sweet spot for what we were looking for in their performance or size. So if we start off with their performance, you can actually see that EAT never changed throughout the 8 years, although they did make some changes to the segment that EAT was in. You can also see, if we go straight from EAT, so you can see the blue line going across, you can see the change going from 2024 to 25 and slowly catching back up to where they were sitting. If we're looking at EB, their performance, although they grew a little bit in 2026, it still never really met the sweet spot. In Echo, it wasn't until 2025 that they changed the marketing segments, but their performance was already well above when they changed it. Edge, they had for the first 2 years before they sold off. It was pretty close over the first 2 years. And then looking at Egg, which again, they never really changed until 2023, and then they slowly increased this as per the sweet spot. You can see how that was growing. Egg was also growing up. Then if we go over to their size, EAT and Egg never changed their size really. There was a little bit of a change in 8 from 2020 to 2021, but then it remained constant for the rest of the time. So it never really went along with the sweet spot that the market was looking for. If you're looking at EB, which is the green lines, they did reduce it down and it did start to get close to the sweet spot, and they did start selling a bit more during these times. Echo, which is the purple line, they changed, like I said, in 2025, and then in 2026 they sold off this segment. It still doesn't really reach the line of the sweet spot that we were after. Edge, like I said the first time, they sold it off in the second year. And Egg, it is the same throughout the whole years, and they never really got close to their sweet spot. Some other mistakes that they've made is their price fluctuations. It was only really in Echo, the segment, which started off as $27.50 in 2019. They raised it by $12.50 in 2020 and brought it up to $39. And then in 2025, they brought it right back down to $24.49. So you can see that these big changes in the price, especially in Echo, might not have been well with the market. So we had some poor forecasting, which led to a lot of missed sales between 2022 and 2027. So in 2022, they had a lot more extra capacity in their EAT and EB segments. In 2023, every single segment they had extra capacity to be able to produce and sell, apart from Echo. Echo, they actually overproduced. In 2024, they overproduced in everything. So they actually did sell a fair bit, but they were well overproduced. I think that they were trying to fix their poor forecasting in the first 2 years. Then moving into 2025, they had extra capacity in EAT, EB, and Echo segments. And then in 2026 and 2027, all of them were underproduced apart from END. So there was a fair bit of poor forecasting throughout the 8 years. Then we lead on to our segment changes. So while they did state in their mission statement and their strategy that they'd get rid of performance and size, they did this in 2023, selling off their performance segment and then changing egg from size to traditional in 2024. They did make a few more changes going through, which I think this was due to their R&D trying to match up with what they had already in the segments instead of trying to change their research and development. So we had EAT change from traditional to low, and then they developed a new product called END into their high segment. In 2026, we had Echo change from high to traditional, and then in 2027, they'd sold off Echo as well from traditional. All right, so now I'll pass on across to Randitto, who will go through their competition analysis and real-life comparison.
Good day, everyone. I will present the competition analysis as well as the company comparison. The presentation of the company analysis will include a market share analysis to look through the market activities over the 8 years period, as well as how Erie going through in the market shares. Secondly, we will look at the product comparison on how the products are selling in the market, what are the pros and cons of us comparing it to the top company on the market, which is Andrews. And thirdly, we will go through the company financial analysis. And lastly, I will present a company comparison. Moving on to the market share analysis, as you can see, we've compared Erie with Andrews because Andrews is one of the top leading company in the industry, and they've also had a consistent growth in the market shares, especially after 2020, where they've introduced 2 of the new products in the high-end performance segment that have boosted their market shares. As for Erie, they've been having a decrease over the year. This is mainly due to the over forecasting and the lack of R&D of the product to meet the consumer buying criteria. But according to the graph, after 2023, Erie market shares increased. This has happened because they've shifted their traditional product into the low-end segment, and Erie taking over the low-end market with the 2 products shortly after. But after 2026, Erie market shares returned to decline because the inability to produce the product because of the plant facility. Next, we're moving on to the product comparison. With the end of year 2027, Erie has dominated the low-end product with total of 29% market shares on the 2 products, AB and EAT. With a good contribution margin of over 30% for both products, Erie has made almost 30 million from the low-end segment as compared to Acre. Ab has less $2 million profit due to marketing budget and a lower selling price than Acre. Unfortunately, Erie could have secured 36% of the market share potential if they had invested in plant capacity on their low-end product to meet the consumer demands. On the other hand, traditional and high-end products did not have a great result with only 7% in end, and N is having loss due to low sales with only 40% contribution margin and a high period cost. Erie could not secure a good market share in the high end due to the high level of competitiveness in the segment, where Andrews and Digby dominate the market by having two products in that segment. Now we're moving on to the financial analysis. We can see the upper graph showing the stock price movement of Erie as well as Andrews for comparison. Erie's stock price have been fluctuating over the span of 8 years, but the major changes we can see is only 2020 and 2024. As for 2020, the lack of R&D has led Erie to lose sales due to not meeting the consumer buying criteria. This also led Erie to have an inventory carry that made them to issue an emergency loan and having a loss of almost $2 million. This issue also affect Erie cumulative profit on the same year, but Erie managed to compensate the loss in 2025 after they adjusted price for it to be more competitive and meet the customer buying criteria. They managed to secure low-end market by 31% with almost 2,900 units sold in 2025, and Erie ended up with 35 million in cumulative profit in the end of 2027. Continuing on to the financial analysis, we have compared Erie, ROA, ROS, and ROE, and it showed that most of the company industry are having a decrease on all three returns in 2020, and three consecutive decrease in the span of 3 years from 2023 till the end of 2025. Most of the companies suffers from decline due to the investment that happened in 2020. Andrews, for example, invests in automation for a low-end and traditional product. Erie also invests in plant capacity and automation in a 3 year period from 2023 to 2025 that led to the declining return. In the year 2024, however, we see that Erie suffers from a decline, leading to have a negative impact on their sales. This is due to the effect of product transitions, where they move it from traditional into the low end. The product transition did not move very well because the lack of preparations on investing in plant capacity and automations in order to push production costs to a minimum. The transition led to Erie having over 1,000 units on inventory from the EAT products alone because they can't meet the consumer buying criteria by having a high cost product. Moving on to the company comparison, with Erie product strategy, which cover the low-end, traditional, and high-end segment, we can see that a company in the world who are having the same product strategy as Erie in the market. One of the companies we can see is ASUS, where they're selling of their product in the 3 segment as well. As you can see, ASUS have an A series laptop on the low-end segment, Chromebook and Book on the traditional segment, and ROG gaming series as well as ZenBook Pro for the high-end products. And the last company comparison is Samsung. Samsung also sell their products based on the 3 segment. J series phone on the low end segment, traditional segment is an A series phone, S series and Note series on the high end segment. Samsung has been quite successful selling the low end segment in India because they have been taking over 28% of the market in 2018 by selling the low end product segment as J series. So they are more compelling to the low to medium income.
As a company, Erie decided to drop out of 2 of their segments in their model portfolio. In 2021, they dropped their performance product, and in 2023, they transitioned their size product into a second traditional product. In 2025, they went on to take this traditional product into the low end. As a result of this, Erie often found themselves towards the bottom of the traditional market segment. They never quite achieved the customer scores that their competitors did. However, they did have one of the best accessibility ratings consistently. This wasn't able to transfer into a market share, however. This suggests to me that Erie used the traditional market as a bit of a stopgap, ensuring that they were always in the market to take advantage of the high levels of volume, but never focusing too much on their product or spending too much. By swapping certain products into the traditional market whenever they were at the ideal age, they were able to profit without investing too heavily. When you compare this to the market leaders, Digby and Andrews, both of those companies paid heavy attention to the traditional market, obtaining high scoring products with their high accessibility ratings. Digby focused more heavily on their awareness compared to Andrews, allowing them to have a better individual product, whereas Andrews took two high quality products into the market and were able to consistently take second and third place with a low selling point and a good product. The low end market is where Erie found their major success. They obtained the highest market share each and every year and consistently took two, even three products into the low end market. Now, Erie found this success, however, without having the highest scoring product on customer surveys. The way they found this success was consistently maintaining high awareness and accessibility year after year and having their price towards the lower end of the spectrum. It seems to me that Erie focused heavily on the low end market, and it does seem that they were able to reap the benefits of this focus. I would say that Erie were the most successful company in the low end segment for the last 10 years. The high-end market, however, was dominated by Digby. They sold the most units and had the highest market share every year starting from 2022. They were consistently the closest performance and size and had high accessibility and awareness, which started at a moderate and then increased through the years. Now, a result of their high-scoring customer surveys allowed them to keep their prices high. They constantly had the highest price in the segment and were able to sell the most units with their product Dixie. Their second product, Dust, which entered in 2025, was always able to compete with other items with the exception of Dixie, meaning that they were able to have not only the most successful item, but also one that would consistently take the second to fourth spot. Now, in the first few years, Erie were competing well in the high-end segment, achieving performance and size very close to the customer needs. However, it seems they didn't maintain this through R&D. They had a major drop-off in 2022, and then it seems that they caught up again in R&D, leading to a great year in 2024. The model that they developed here allowed them to coast off the success of the previous year for one more year, but as competitors consistently improved, they found themselves too far off the mark and weren't able to obtain those sales numbers again. It doesn't seem that they were focused too highly in the high-end market, and by managing to have multiple successful years within the last decade, they were able to make profits when needed and not invest too heavily. With Erie's focus on the low-end market, utilizing their other products when possible to keep a sustained income, it looks that they have a good hold on the low-end range. As long as they don't make any drastic changes in their approach to the low-end segment, they'll be able to keep that market share. Now, they could potentially look at putting more emphasis into these other two products off the back of this high achieving low end. If no real changes are made to the game plan and strategy, I believe that Erie will steadily increase their success. Their stock price has been on a moderate rise ever since their early dip, and I can't see any reason that this would change without major shakeups within the company. Their control of the low-end market and their relevancy in the other two markets occasionally allows them to continue being a moderately successful, safe company. If we were brought on as consultants to this company, what we would recommend is what I previously mentioned, entering more heavily into the high-end or traditional markets. Now, at the current time, I believe that high-end would be prioritized, and if successful, use that to launch into the traditional market. Using the profits from the market domination of the low-end segment, I would look to improve the R&D facilities, allowing for more regular updates. Now, if we did this, we would be able to keep a more in-spec item that can compete with the high-end products. Now, since there are less overall products in the high-end market, the barrier is a little bit lower. However, as a result of this, the products that do already exist are of a higher caliber, meaning that if attempted, you'd need to ensure that the product is right to compete. Now, I believe whilst investing in R&D and planning the first R&D product, At the end of the third year, when the product releases, they'll be able to take a look back at how it went. If successful, I believe it is worth the risk of moving into the traditional product with any product that has an age of around 2. Now, if it isn't successful and they're still struggling in the high-end segment, I would suggest using the next 2 years to continue to break into that market, looking back every 2 or 3 years to see whether or not it is time to branch out further.